minutes. I love their downtown. It's super nice. Okay, I'm going to start recording and then I'm going to start letting people in, start webinar. And then I'll do an introduction for you guys and then basically I'll cue you guys in to start. And then Jesse, if you don't mind switching to the second screen when I do the CAREA board of directors, you'll know it's like our mission statement. And then that's the only thing that you need to do until you guys start your side.
No problem.
Oh, here we are.
Did you say there's going to be maybe 1,000 people?
No, not 1,000.
Like, wow.
No, not 1,000. We have about just over 1,000 members. And so typically about anywhere between 50 to like 100 people will RSVP, sometimes upwards of 200 if we have a very interesting topic. But right now, CREA, we do have a lot of residential agents in our members. So commercial wise, we probably have about 30% commercial and then about, I would say 60% residential. And then 10% of that other category is like vendors and other professionals like stagers and escrow and title in our network.
Okay. Is there a certain time frame you'd like us to stick to?
Yeah, so we typically have these for about an hour, and then sometimes we can leave additional maybe 15 minutes towards the end for a Q&A, but normally we keep it at the 60-minute mark, where about 45 minutes is the presentation and 15 minutes at the end is plenty. Okay, I see quite a few people on joining us. Welcome, welcome, welcome. We'll give it a few more minutes. Thank you for joining. Hi, Angela. Hey, Eileen. Genzo, Jimmy. Hi, Yen. Bradley, welcome. Carol. This isn't like Zoom meetings where we can have everybody's like beautiful faces. It's webinar style. So although they can hear us, we unfortunately can't hear everybody, but
Yeah.
At least we can.
They can chat, I believe. And
yeah.
For the end.
Absolutely.
Q&A for the end.
Yeah. So everybody who's joining us currently, go ahead. You can warm up our chat box if you'd like. Type in where you're logging in from today, or maybe how you heard about us. And then before we get started, I'll go ahead and start some of our housekeeping items. So if you're logging in from your computer today, you'll notice 2 areas where you can participate. And everybody, we're all quiet today. So let me just paste our Facebook information in our chat box. And then if you do have any questions, because I think today's topic is going to be really relevant in terms of our business planning and how we can update and stay current for our clients. If you want, I'm going to be taking copious notes, but if you have any questions as our presenters are speaking, go ahead and put them in the Q&A box. And that way we can keep track of everybody as those questions roll in. And then lastly, to stay current on all of our, hey, Cecilia, and Tarot Burlingame, awesome. So to stay current on all of our future events, please add us on WeChat and Facebook if you haven't already. We will have off-market listing deal-making events coming soon, especially every, I think, 4th Thursday on lunch hour is kind of our broker deal-making session. So if you're interested in that, make sure to join Facebook. We could go ahead and RSVP through there. And then we are right on the dot, 12 o'clock. All right, let's give it a few more minutes. Please introduce yourself. Yes, please. Okay. I love it. Okay, let's see. Let's give it a few more minutes. I know a few people are just coming on. Let's see. I typically like to start fairly close to our 12 o'clock. So maybe I'll get started on our introductions and then people can come on, as they join. Perfect. All right, let's get started. Welcome to our CAREA Zoom webinar speaker event on CoStar's 2021 SF Bay Area Commercial Real Estate Market Trends. I'm Michelle Chen, a commercial real estate broker with GD Commercial and part of this year's board of directors for CAREA. And I am so excited to be hosting today's webinar presented by CoStar analysts Jesse Gundersheim and Marco Cugia. I'm so sorry, Marco. Is that how you pronounce your name? Your
Yeah,
last name?
Cugia, yeah.
Yeah, perfect. Before I invite Jesse and Marco up, I wanted to thank everyone for joining us today. I know you could be doing many things during your lunch hour, and although I really miss meeting in person, I'm so thankful for our technology today, such as Zoom, to allow us to stay connected and learn together. And then, can I get the next slide to briefly introduce us? The Chinese American Real Estate Association is a nonprofit organization established to promote promote the social and economic well-being of our associates and further professional image of Asian Americans who are engaged in the field of real estate. We warmly welcome you to check out our website and join and become one of our members. For details, please check out CAREA.org. So let's get started by welcoming Jesse and Marco. Jesse is the Director of Market Analytics for CoStar, covering the San Francisco Bay Area, and he provides market analysis and identifies market trends, helping owners, investors, and lenders minimize risk and maximize returns. Marco is a Senior Market Analyst at CoStar, and working within the analytics team, Marco is responsible for analyzing commercial real estate trends and maintaining market reports for the San Francisco Bay Area. Let's welcome Jesse and Marco. Go ahead.
Thank you so much, Michelle, and everyone for having us. I'm honored to speak to you guys. It's what we do often. We monitor the trends in the Bay Area that the CoStar platform collects. We've got probably the best commercial real estate information and data in the entire industry. So we focus on the Bay Area, and we talk to clients a lot and tell them what we see in the market. So happy to take you through what we're seeing, how the market, has suffered amid the pandemic. We've got about an hour, Michelle says, so we're going to run through the slides rather quickly. It's a lot of material, but we're going to try to make it as interesting as possible for you guys. And we'll probably open it up for a Q&A at the end, just so we can get through them within the hour time frame. So, starting off with a beautiful picture of SF. We all know it's a great place to be. A lot of us live there. But, it's got some issues that have really come to a head point in the pandemic. The high taxes, the high housing costs, the cost of living, lackluster public services. So all of these issues have kind of combined in a way simultaneously that they haven't in the past, which has led to some outflow from our markets. And we will discuss all of that. We're going to focus primarily on the two major food groups of commercial real estate, the office and the apartment market. And we'll take you through how vacancy is up, how development is down, how rents are down, and how investment volume is down, but prices may be hanging in there a little bit. Obviously, there's been negative ramifications of the pandemic that materialized last year. And there's been a few bright spots like biotech or distribution warehousing, but for the most part, the office sector and the multifamily sector, meaning apartments, has really suffered. And they've suffered to a greater degree than any other market across the country. In fact, we're kind of ground zero for pain in the pandemic. Although we don't have virus cases as high as they were in New York and LA, our commercial real estate has suffered greater than those markets have. We'll do a quick overview of kind of some economic measures that kind of paint the picture that we're suffering more acutely in this region. Here we're looking at Bay Area employment on a overall metro level. Metro division in San Francisco is down around 10% as of August report. So it's traced back a little bit since then, probably down around 9 or 8%, which is more than the national average, slightly more than the national average and slightly slower than the national average on the comeback so far, which is actually a trend that, has played out historically in our market. In down times, the market tends to suffer more acutely than the national average. And in the boom times, we get this really strong growth that tends to be stronger than the national average. So, while bad, there were a lot of forecasts that were saying, we might help hold up better than other regions because of our prevalence in tech. That's blown out the door. We're back to our historic trends. The market does suffer more acutely than the average in the downturn, and that's what we're seeing now. In terms of shutdowns, that's been a big part of it. Non-essential office use is still not permitted. It was cut off earlier than other areas. And we're masked up a lot. We've got a lot more restrictions on just the economy than other areas. Our restaurants were completely shut. Now we can open up for at least for outside dining. But some of these restrictions on hotels, malls, and gyms, nail salons, they're more strict in the Bay Area. And I think that's led to this more acute pain economically. As far as the forecast model goes, this is from Oxford Economics. They're projecting that we will regain our pre-COVID employment levels sometime in late 2022. So not really looking for as sharp of a bounce back that probably many people have anticipated. And this has basically, been drawn out over time. As time progresses, the forecast model goes further and further into the future as far as when we're going to regain those peak employment levels. More evidence here from Yelp. Friends at Yelp reporting that San Francisco, I believe this includes the East Bay as well, has the highest percentage of business closures across the entire country, second only to Honolulu. And then you got Vegas right there, two markets that are really heavily dependent on tourism, but we're right there smack dab in the middle. Terrible measurement there. I talked about the offices being shut. You can see our metro still lagging behind here at only 12% use according to Castle key card systems, which is much lower than the national average and even lower than New York in some instances. So we're really not back in the offices. A lot of people have left their apartments, which we'll discuss at length and in depth. Consumer spending also down here. As of this latest rating in the beginning of January, you see we're down here still 9.4% from pre-COVID levels. The national average is doing a little bit better. I think it even boosted above its pre-COVID level. Some sectors are up like grocery and retail, but for the most part, total spending is down as well. And checking in our tech economic indicators, I think these are holding up fairly decently. You see some slippage in terms of VC investment, but I think this is, a stalwart that says we're going to remain the center for tech for time to come. I see a little bit of outflow to other areas, sure, but we're not going to lose our status as the primary hub for innovation soon. It's just so strong here, and so even if you get some losses, we're still going to remain by far ahead on top. It's about on par with New York City right now as far as the Bay Area, but those two areas are going to remain the top two destinations for VC deployment and tech firm generation overall. But the story or the question really is maybe how much, the growth from tech moves from San Francisco perhaps to other regions. Give you a lay of the land. We'll talk about all that in the upcoming hour. Our San Francisco Metro division is going to incorporate San Mateo County. San Jose is going to cover all of Santa Clara and San Benito County, not just the city of San Jose. And the East Bay, of course, is going to be Contra Costa, Alameda counties combined. So I'll tell you, start with the office leasing activity. Everybody know that was completely shot at the onset of the pandemic. We've seen really moderate comeback in activity so far. You can see the fourth quarter here, slightly above what we saw in the second and third quarters after the pandemic hit, but well below levels of leasing that we saw throughout the expansion cycle, basically back down to global financial crisis levels. When will it return? Shots in the arm are going to help, but I think it's going to be a slow rollout overall based on what we've seen so far in the vaccine. I know my dad is over 75. He's gotten his first shot. My mom is under 75. She's still waiting for hers. So I'm just kind of doing the math on when this is going to roll down to, everyone all the way down to millennials who need to be in the offices. I think it's going to take several months. There's so many lingering questions of people who won't want to get the vaccine, who's going to be able to go into the office, how many people are going to want to be going into the office, can you use that office, when can you use that office? So a lot of things to be decided and played out. I think the leasing volume will return at sometime next year, but I would target kind of later in 2021 than early this year. That would be my guess. It's largely a sunken expense at this point. So why go out there and commit to space that you don't even know when you'll be able to use it? And in terms of our office market fundamentals here, you can see the vast amount of downturn in occupancy. This is our net absorption here. This is the change in physically occupied space from one period to the next. So CoStar researchers are tracking in excess of 7 million square footage of office space that was vacated on net last year. You can see in comparison, which actually beat the global financial crisis downturn. And it's quickly approaching those of the dot-com crash, which everybody knows is devastating for our market. I think it's the downfall this time, how strong it is somewhat being lost, that we're really approaching those losses of the dot-com. If the pace of losses that we've seen in 2020 continue into the third quarter of this year, then we will have matched those losses of the dot-com crash. And I think that's quite likely to happen. We're seeing more negativity on the board in the first quarter. It's shaping up with 1.8 million square feet of negativity so far, just through January and the first week of February. So, first quarter is definitely going to be down. Real estate is a lagging indicator. There's still news coming out where major employers are downsizing their space. Salesforce said that they're not going to need all the office space that they have in every city throughout the country, including in San Francisco. Marco, how about your wife at Old Navy?
Yeah, that's another good example. Gap and Old Navy. Old Navy had actually purchased a building that they had been occupying for some time in Mission Bay, a very hot area in terms of office leasing and development recently, and they're pivoting. They're going to consolidate into the existing 2 Folsom building they have in San Francisco, but that's a big pivot, and it certainly indicates, they haven't formally announced anything, but it would seem to indicate that they're going to go to more of a hybrid model, which is not something they had done traditionally. And Gap's obviously a very large company and headquartered in San Francisco, and it's a pretty big change for them in terms of how they treat their, what their expectations are from employees being in the office and kind of how their office footprint looks like.
Yeah, so it's from non-tech firms like Gap and Old Navy. It is dominated by tech firms though, who they really get ahead over their skis kind of in the expansion cycle. They were planning for really strong growth over the next 5 years, and that's what they were planning for office space. In the pandemic, all of a sudden those plans have turned on a dime, right? They don't know if they're going to need all that space. If they do, maybe they need it in other areas. But the work from home movement is really having a damaging effect on our market acutely because of our prevalence in tech and high finance. Those are 2 areas that can really kind of go remote easier than others. So that's why you see the downfall here. We expect that to continue moving forward. Now, a lot of these companies who are sitting on space that they don't need for the time being or don't anticipate using for the time being has been dumped for sublease. This is the highest percentage and amount of sublease space that has ever hit the market, even exceeding the dot-com crash. The corporate tenants are still largely paying their bills. There hasn't been much pain in the corporations, but they just decided they don't need their space, and so they're willing to sublet it. A lot of it is going to burn off quickly over this year, next year, but some of it, is over the next 4 years. So I think as some of it burns off, it returns back directly to the landlords. There's going to be more pressure on landlords to lower rents and compete with so much vacancy on the market and so much availability out there. It's just a who's who of who's offered sublease space. You get Twitter, Stripe, PayPal, StubHub, Yelp. Uber was already listing a wealth of their existing offices for sublet in anticipation of moving to their new headquarters in Mission Bay. But it's all over the place, and it's high quality space, and much of it is being offered at a steep discount, just as those in-place tenants try to recoup some savings. There's a comparison across the board. You can see our market began its upward trajectory before the coronavirus hit, but the pandemic has really exacerbated those effects, leading it, I think, above 6% now. This is only reading through third quarter of last year, so we're higher than that now. And roughly 40% of all available space in the market is now for sublet. You can imagine how that's going to bite into landlords' negotiating power on a direct basis. So Twitter talking about decentralization. Was it Pinterest who bailed? They paid about $100 million just to get out of a 10-year lease on a building that they had pre-leased that wasn't even approved for construction. So like a perfect example of how aggressive they were thinking on the long-term 10-year and then the sudden pivot. and even willing to give up such a high amount of cash to get out of that commitment. I talked about our industry makeup. This is an interesting study that some of our folks at CoStar created based on the Dallas Fed, I believe, came out with each SIC a propensity that it could go remote. So we used those, splice them into each market and see within market how many workers are likely to go remote based on their employment categories. So certainly San Francisco on the higher end of that, San Jose even higher, Seattle, very high tech markets, Washington, DC, a lot of office using workers in there. So we do end up on the higher scale of that spectrum. And of course, the relationship between that and the rise in sublease space, with San Francisco notching the highest increase in sublease space. This is just tracking from the fourth quarter 19 through the end of last year. They increased by over 3%, rising from that 3% up to the 6% total that we see now. I mentioned the forecast still has some downturn in it. I think that makes sense based on our slow growth trajectory and what we're seeing that kind of play out so far. Some of the forecast model takes the recent trends and just extrapolates it forward. And you see, even with some pretty strong absorption levels here in the forecast that match kind of what we saw in the expansion period, it's going to take several years to make our way back down to the vacancy rate that was so compressed in the expansion cycle, just based on how much space was given up over the past year. Now, San Jose is hanging in there quite a bit better than the San Francisco market is. There's more established tech firms that are dominating the market there. Not as many kind of startups or kind of, I call them mid-market tenants in San Francisco, the Ubers, the Pinterest, these guys, they've been around for upwards of a decade, but they're still kind of startups. They're still not profitable. They're still kind of, aiming to IPO in some cases. But San Jose is more dominated by those established tech tenants. And those guys have actually been the standout. The Facebook, the Google, the Apple, Amazon are really the only guys who are still expanding, not so much in our region, but actually in other regions across the nation. But those guys are not giving up space, at least in our market so far. They can continue to take new occupancy in properties that they pre-leased prior to the pandemic. And then I believe Google just announced that they're going to resume acquisition activity sometime this year. So, pretty decent measures. You did see some negative absorption in that market, and you did have some supply growth. So a little bit of a misnomer here. This supply growth was pretty pre-leased, so you would expect the absorption to be positive, being that most of this brought in some gain in occupancy. But if you take out, if you were to separate those new deliveries, you would see the downturn in absorption being even stronger than what we're showing here, as tenants left those existing properties that were not new. And the forecast model, we're projecting positive absorption next year for the San Jose market, but not to the extent that it keeps up with the robust supply growth. As I mentioned, most of this is already pre-leased, some of it not, but you get downfall from the existing inventory that's not new, that's gonna not keep up with the pace and thereby increase our vacancy rate even higher. Up towards 12%, not terrible, but certainly higher than what we saw in the expansion cycle.
In the East Bay, obviously a pretty negative year, north of like 2.5 million square feet in negative absorption. Similar to San Jose, that new supply was actually fully pre-leased as well. So to kind of take that out, it's a little bit worse in terms of negative absorption that we're showing, and kind of an all of the above situation in terms of causes. There's direct space and sublet space flooding into the market from really what seems to be smaller to mid-sized companies under 40,000 square feet. A lot of the spaces were even under 10,000 square feet. So certainly kind of indicating that companies in the East Bay, which are typically maybe more professional services or smaller companies, are having more of an issue paying rent, or just have more of an ability to kind of make that decision of we're going to shed some space, or we're not using this office space right now. We can work from home. But whatever the case, may be in those individual companies, that was very widespread. We also had About 400,000 square feet in space go under renovation, which vacated. Most of that's pre-leased and being renovated for a tenant. So maybe not quite as negative as the metrics show, but certainly a fair amount of negative news. There was some wins for the year, though, that I think are worth pointing out from a long-term perspective in terms of the East Bay's forecast and the types of tenants that the East Bay typically generates. So PG&E is going to move over to Oakland from being in San Francisco for over a century. They lease 900,000 square feet at 300 Lakeside Center. So they're going to move their headquarters to downtown Oakland. This follows a couple other companies. Credit Karma also announced this past year recently that they're going to formally move their headquarters to downtown Oakland. They had leased office space in that new building that delivered in 2020, in 2019, but they hadn't formally announced that was going to be their new headquarters. It sounds like that is going to be the case now. So the East Bay continues to maintain kind of a cost for cost-sensitive tenants or for tenants looking to save some money on real estate costs. The East Bay provides a good opportunity for that. Another good example this year, and a continuation of a trend for the past couple of years, has been down in Fremont. Facebook now has over 1.5 million square feet in the Ardenwood district of Fremont across mostly office buildings, but some flex buildings as well, right across the bridge from their Menlo Park headquarters. But a good example of, rather than trying to compete in a higher cost market, they recognize that a lot of their employees are living in the East Bay. Let's just go build out a campus at a much lower cost in a city like Fremont that has the office space available to meet their needs and allows them to kind of build out a campus. So I think that's why we see the East Bay kind of in the long term here being able to hold up along with lower supply pressure. So still expecting some increases in the vacancy rate, but not severe, and a little bit quicker recovery than maybe we're seeing in San Francisco.
Yeah, and the AT&T move to the East Bay is just a great example of cost savings. Other popular locations, of course, Texas with Oracle, Elon Musk, and Tesla most recently announcing their headquarter moves over that way. Oracle's been dumping space throughout SF and their headquarters in Redwood Shores. So, yeah, and the long-standing tenants, it's pretty damaging to see a 100-year-plus company, but them and the likes of Bechtel and Cormac Holdings and McKesson, with their One Post building, these are long-standing tenants in San Francisco. The trend of moving to lower tax states emerged well before the pandemic, but I think has been exacerbated recently. So you see the vacancy spike in San Francisco really outpacing what you see in the South Bay and the East Bay in the downturn. The North Bay markets, they're holding up a little bit better. They are seeing some occupancy losses, but I think there's the question of will companies begin to set up satellite offices in the North Bay? If you don't want to commute into the city from there, it might make sense to open up a small office there. I think it's more of we're waiting to see that happen. It sounds like a good idea, but I think it's yet to be evidenced, at least in the North Bay. You're definitely seeing it in the East Bay, as Marco talked about, but North Bay a little more isolated from a transportation perspective, and just doesn't have a ton of office space overall that's available. There are some decent quality spaces that could be taken from a tech firm should they desire to do so. Just waiting to see if that's going to happen or not. So there were certainly some constructions that were put on pause amid the downturn. Boston Properties has a couple projects in downtown San Jose, or in the San Jose market, that are on hold. Overall, developers timed this cycle fairly well in San Francisco, as in the projects that were developed in the expansion cycle were fairly pre-leased prior and completed prior to the pandemic hitting. Now there's this new crop that recently gained approval, but developers really haven't started initiating construction on these projects yet. They remain viable and can move forward should the tenant demand, need it. But for the time being, I think these are largely on hold. So overall, construction levels are still fairly elevated, though, because of the strong run-up that we had in the expansion cycle. So those projects have not completed. They're just on the verge of completion, such as Uber's Mission Bay headquarters, Facebook, Burlingame Point, Facebook's pre-leased Moffett Towers 2 down in the South Bay. But those are some of the projects that keep our office inventory growth levels actually elevated as compared to the national average. San Francisco, Again, I mentioned a lot of those pre-leased Uber and Facebook. It also includes the 1.2 million square foot Oceanwide Center project. You guys might be familiar with that one. It's on hold. The sale to Honey Capital, I believe, fell through at the end of last year. So it's a cash-strapped developer there, and they're probably going to need to unload it or receive more capital injection to resume that project because construction has completely been on hold. So it's a little bit of a misnomer here, as it looks a little bit inflated for San Francisco as compared to what is really happening on the ground. But San Jose, you know, that's a market where developers continue to build on spec basis. Even through 2019, there are some buildings that are delivering completely vacant in the South Bay right now. That's leading to the big vacancy increase. But that seems to be a market where developers are more confident about the long-term and even short-term prospects, continuing with the construction rally there. And you can see with good reason, they've got really strong pre-leasing in that market. Nearly 80% of that stock underway is already pre-leased. San Francisco, I mentioned good pre-leasing, and then the bulk of what's not pre-leased is really Oceanwide Center. And then there's a 600,000 square foot 5M project that is underway still in the city as well. And these days, not much happening for construction. Really, the rent levels there didn't quite justify so much office construction. So developers really didn't move forward too substantially there. So that's kind of the roundup on fundamentals and how they've weakened. And to little surprise, we've got a downturn in rents in response to that, in response to the downturn, and also in response to the increase in sublease space, which is often offered at a slight or even very strong discount to direct rates. There's a couple of buildings in the market where, man, the sublease asking rates are just a quarter of what the landlord is asking for direct rates in the same exact building. So that's figuring into our overall market average here in San Francisco, which is down around 8% on a year-over-year basis, which leads all nations to the negative. Makes sense considering we've got the largest vacancy spike and rising sublease availability. I think landlords are going to eventually capitulate and lower their rents more substantially moving forward. We did see stronger downturns in the global financial crisis in terms of percentage rent losses. And considering that we've seen even stronger occupancy losses in the San Francisco market, I don't think that would be a surprise to see those rents, fall to the excess of 20%. So probably maybe only halfway, I think, as far as what we think for a forecast model there. San Jose is hanging in there a little bit better, considering they've had, slightly less occupancy losses. East Bay kind of stabilizing there.
Yeah, East Bay's been relatively flat. And yeah, I think, to your point, this might be lagging a little bit, and maybe landlords are trying to take a wait and see approach in terms of if leasing activity, bounces back at some point, what's that demand look like, and how much rent decrease is going to be necessitated by that, change in demand, where right now there's almost no demand. So it's difficult, probably from their perspective to justify, posting a much lower rent than they previously had without really any hope of leasing that space in the near term.
Yeah, without a lot of, lease deals transaction, it's kind of hard to know where the market is, where you can get someone to take that space, since there isn't really any leasing happening. But that'll be sorted out over the next year. Got the stats here. The rents did fall 56% over 12 quarters following the dot-com crash, by about 22% over 6 quarters following the global financial crisis. So, it is kind of steep, but the currently forecasted decline here is about on par than with what you saw during the global financial crisis, at least. And I think there's reason to believe it may go down even further. But then we see the eventual bounce back, towards the end of 2021, anticipating the return of some demand there. But, it could take years to regain those peak price levels that we saw in the expansion. People are going to want a space eventually in San Francisco, but at what price point? Are they going to be willing to pay over $100 per square foot for that premium trophy space? I don't know. The viability of expanding in other markets or in people's homes seems to be much stronger now that we've done this forced work from home experiment. Now, in terms of sale trends, it's a little surprised volume has downturned, but I think it's held up rather well considering the macroeconomic environment here. You can see the downturn from last year, but not bad in comparison to what we saw throughout the expansion cycle. There's certainly a downturn after the pandemic. People kind of froze for the second and third quarter, not much traded. At the end of the year in San Francisco, we saw a couple of trophies trade, and we'll get into those. And the South Bay market had some well-leased assets to, still premium tech tenants or biotech tenants who are on solid long-term leases. Those are still viable investment opportunities. Even at low cap rates, you've got institutional investors and foreign investors who are, interested in buying in at a 4% cap rate in our market. That makes sense to them. So something still trading. Properties with material lease-up risk, that's going to be sitting around and not trading as much. This project here, Transamerica Pyramid Center, does have some lease-up risk. Yeah, I think it's a great example of the downfall in pricing that we saw. It did trade, but at a 9% discount from pre-COVID pricing guidance. And also it was financed by the seller, Transamerica. I think the downfall in pricing could have been a little bit more extreme had Transamerica, the seller, not stepped up and provided the financing to the buyer, kind of a private buyer, Michael Schvo out of New York. First time the pyramid has ever sold in its history. So that's very interesting. And then, as I mentioned, well-leased assets to long-term tenants are still garnering solid investment interest. This is a foreign investor, Singapore-based Ascendas REIT, acquired 510 Townsend and 505 Brandon Street for over $1,200 per square foot at a 4.9% cap rate from the building's developers, Alexandria Real Estate and locally based TMG. So the 7-story 510 Townsend building is fully leased to Stripe with a remaining 7-year lease term at the time of sale. 505 Brandon is Pinterest headquarters and has 12.4 years remaining on its lease at the time of sale. From the buyers, this acquisition allows us to plant a foothold in San Francisco, one of the most dynamic and progressive cities in the US. The properties are newly completed in 2017, are fully leased to 2 high-quality technology tenants. So a great example there. I think despite falling rents and elevated tenant risk for some assets, San Francisco clearly remains a premier market for office investment. It's a global gateway city, and those are going to remain in probably in favor even through the downturn and certainly in the rebound.
And then by far the largest sale in the East Bay last year, and again another tie into PG&E's move over to Oakland. So TMG Partners purchased the Lakeside Center for $450 million. This went through in the fourth quarter. And then so the 300 Lakeside building, that's going to be PG&E, their new headquarters. TMG is going to manage the renovation for them, and then they're going to phase into that over a several-year period. Then they came with a second building, 344 Thomas Berkeley Way. That's a 125,000 square foot office and retail building, also a parking structure. So I think, to Jesse's point, well-leased asset, you feel confident in the sale price. PG&E has a purchase option for 300 Lakeside, and then I think they maybe have long-term development aspirations to go more vertical for the second building. So a couple different areas of upside here for this sale, which really dominated the East Bay's activity for the year in terms of volume.
Yeah, so we haven't seen much movement upward in cap rates so far. Interest rates were lower. That's probably a big reason. Capital is still cheap. There's still plenty, pure asset buyers who have cash or are willing to dole it out. So cap rates are, rather stable, maybe inching up just slightly, 10 basis points or so. But the downfall in rent potential is kind of playing into our overall market average pricing here. You can see the downturn in San Francisco last year. So overall, kind of up a little bit in San Jose and kind of stable in the East Bay because cap rates are rather steady. And you haven't seen the material rent losses in those markets yet. So we're going to be watching the sales activity closely to see if volume kind of returns to those peak levels that we saw in 2019. But there's a lot of risks that still weigh on the market: the job loss, remote work, high cost of business, the tax environment. I don't see that turning around anytime soon. So those are two factors: work from home and the taxes that I think are going to bite into demand and investment demand, even for the foreseeable future. Certainly things to watch out for as risks when you're talking about investment. Vacancy is clearly rising. Sublease availability has spiked in San Francisco. It's up in San Jose as well. San Jose is the second leading market for sublease activity. It's up substantial there. Only about half the total of level that you see in San Francisco, but certainly something to keep your eye on. Rents are falling in response to the downturn in fundamentals and rising sublease space. Activity is down overall, but still some assets are trading at a lower price point. So asset valuations are sliding, as I mentioned. All right, so that's going to lead us into the apartment market fundamentals that we track. We've got a picture of the U-Haul van, moving van up here, because that's what's prevalent on the streets of San Francisco right now. This is a report from U-Haul. Customers leaving the Bay Area during the pandemic include Sacramento Roseville corridor as the #1 leading destination. There's a lot of flow both to Sacramento and from Sacramento into the region right now. That's the #1 by far destination for people that are moving out to. Then you get San Diego and Stockton. And outside of California, the top destinations are Reno, Las Vegas, Portland, Phoenix, and Seattle, according to U-Haul. Texas and Florida are the top 2 destinations from 2016 and 2019. Texas flipped to second, Florida is third, and the #1 inflow state was actually Tennessee. The volunteer state posted the largest net gain of U-Haul trucks crossing its borders in 2020. And Tennessee, as Texas, is a tax-friendly environment. This really explains why people are beginning to move there. We've got, what is it, a 13% personal income tax rate in California, which may be proposed to move up to 15%. If you can get out of that and move to a 0 tax rate environment in Arizona or Texas or other areas, that may be advantageous for you if you're provided the opportunity to work remotely. And also, why kind of stay in San Francisco and pay up for those high rents when there's nothing to do there? Your offices are shut. And that's largely the reason why you're living in San Francisco, right? To be close to your offices, to get out to those awesome restaurants, to enjoy the nightlife, to enjoy the Warriors and the Giants. None of that's really happening right now. So, why stay in a shut down city if you have the ability to relocate? You don't have to be in the office. For now, you might as well take the opportunity to pay a cheaper rent elsewhere, that maybe even a better environment for you to live in, outdoor open places. I mentioned the top destinations, but even smaller areas throughout the entire West Coast, like Provo, Utah, or Coeur d'Alene, Idaho, all these places I've seen an influx of Bay Area residents moving to there for now. A recent report from the Department of Finance showing that the population growth within California continues to dwindle for a variety of reasons. I think this next chart really kind of bears it out. This is focusing just on the San Francisco metro. So, it's slowed steadily over the past 5 years, including San Mateo County as well as San Francisco. The population increased by just over 20,000 people, or by 0.1%. from July 1st, 2019 through July 1st of 2020, which was reported on in this latest Department of Finance release, which came out in December. So only through July of 2020, you would imagine there's even stronger outflow from the area. In the later half of last year, that happened. But I think it's housing affordability that we've talked about. It's always been a growing local concern and probably a key driver of this slowdown in population growth. We're still the most expensive market in the country for apartment asking rents, despite the huge downturn that we will show you about in the future. But middle and lower income residents were already moving out of the area before the pandemic. And I think some high income renters have now joined that exodus, leading net domestic migration losses lower since 2016. Those domestic losses have even grown to outweigh international migration into the area. International migration added nearly 10,000 residents in this year latest year that we're tracking here. but the inflow from foreign lands were outpaced by the net loss of domestic residents. That's those that have been within the area in at least a year already. So, less people coming in from China and India. Those two countries dominated our inflow in excess of 80% of the people that were coming over. These were highly paid, well-educated employees who were largely taking jobs at high-flying tech companies. Well, hiring is down, international travel and just migration overall is probably slowed in the pandemic as well. And Michelle talked to us about people who are returning back to China right now. So that's an interesting anecdote and plays into these figures as well. And then you get the births minus deaths. People don't have as many babies in the downturn. That's come to foot, and the deaths have actually increased as COVID has played out across the nation as well. So, and now we're threatening to go negative in terms of our overall population growth rate now. I mentioned just 0.1% positive in this final year here, but the net migration turning negative overall in the last 2 years. I would imagine that continues as we saw in the prior downturns here that lasted for some time following the global financial crisis. You see the slight downfall here and come back in the, global financial crisis here. The dot-com crash lasted for several years. And I think, maybe we're ending up somewhere in between this downturn and this downturn here. So, we know a lot of people have left the area. Are they going to plan to return? Some of these surveys are pretty damaging. This is Blind, an anonymous professional network who ran a survey of tech workers in 6 major cities, including the Bay Area, New York City, Seattle, LA, Chicago, and Austin from September to October. 30% of the respondents had moved out of their side of their metropolitan area where they resided before the pandemic. And only 40% of them say they're planning to move back within 3 to 12 months. So that's the 40% as an average here. But the Bay Area, much lower, only 20% anticipating a move back to the Bay Area over the next 3 to 12 months. So in terms of the employees that left, they're planning to stay away. So kind of damaging evidence here for the apartment market fundamentals.
Yeah, I think this is maybe more, even more so concerning, because I think we all wrap our heads around why someone might, leave, particularly in an apartment community where you're probably more mobile, less roots established. You get a year to, go live somewhere where it's cheaper. That was maybe more opened up in San Francisco or San Jose. Sure, that makes sense. But, if a large enough portion of people who left don't come back, it starts creating maybe a bit of a longer term issue in terms of apartment fundamentals.
The survey said 20% of Bay Area professionals would be willing to accept a 10 to 20% pay cut in order to move. Some tech firms are not even giving a pay cut. They're just saying you can move out of the area and maintain your same salary. So again, that's advantageous for some people. But the downturn in apartment market fundamentals is even stronger than what we saw the downturn in the office market. This is just, the difference in property types, really. The office market, you're on long-term leases. It's corporate tenants who maybe still be doing good, but renters, their leases are up within a year. They have the ability to move and get out of there, much more easy than an office tenant does. So really unprecedented losses in the apartment market. We're tracking over 9,000 units that were vacated on net last year, on top of over 2,000 units which were completed amid the pandemic last year. So we still have pretty decent supply growth coming into the market while demand had really moved away from the market. So spiking up towards 12% from below 6%, more than doubling in the downturn, well above what we saw in the dot-com crash or at any other point in the apartment market. We think that pain continues for some time to come until eventually subsiding next year, and then we return towards the positive growth trajectory in 2022. Another thing to mention, the eviction moratoriums are still in place. They'll likely be extended and extended, but eventually I think when those expire, kind of the tenant base there, will be susceptible to moving out, particularly in the workforce housing, who may be more vulnerable. to the current dynamics and just be hanging on from the added benefits, or maybe they're not even paying right now and they're just maintaining a place because they have nowhere to go and no other options. But I think there's excess loss that's yet to be realized, considering those protections are still in place.
In terms of the East Bay, we didn't see the same level of occupancy losses, and I think the East Bay was kind of the in-between point in terms of some of the broader national trends that we witnessed in 2020 in terms of flight from more urban areas into more suburban areas. I think certainly the East Bay benefited a bit from outflow to some degree from San Francisco and San Jose being a bit of a cheaper market, and then as well being kind of a broader, more suburban market that had, if you think of a downtown Walnut Creek or Pleasanton's, probably a greater ability to move towards an outdoor dining type of experience where things stay a little bit more open than maybe a San Francisco did. The problem in the East Bay is that developers have in no way timed this correctly. We are approaching just almost historic levels of new supply right as we're getting this demand shock and then this increased level of uncertainty. And that's not really going to subside for a couple of years. So while the East Bay is holding up a little bit better on net in terms of generating some demand and not seeing as much of a population outflow, there was some of that. There's definitely lower demand and nowhere near the amount of demand that was going to be needed to absorb in an efficient way the amount of units that are coming online right now, particularly given the fact that most of these units are luxury and targeted towards commuters into downtown Oakland or nearby stations in Fremont, where you're banking on a commuter or someone looking to kind of have a live work play dynamic in a downtown Oakland. The demand trends flowing away from that type of product creates a bit of an issue. So huge spike in the vacancy rate with the forecast expecting a bounce back in demand, and certainly we expect to see some of that, but I think there's still a lot of uncertainty in terms of absorbing these new units and trying to stabilize occupancy rates across the metro. And then in San Jose, kind of a bit of both. Really robust level of supply continuing in 2020. That hadn't been a problem previously, given in the expansion period, the amount of hiring that tech companies were doing and expanding in the metro. All those units were largely being taken up. The vacancy rate was just ticking up slightly. We saw the outflow of population, not as severe as San Francisco, but pretty similar and for similar reasons. Particularly with tech companies flagging pretty early on. Summer of 2021, even now it's being pushed back further in terms of when we'll be back in the office. That frees people up to move out of some of the higher price submarkets and search for affordability elsewhere. And then somewhat similar to the East Bay, not the same level of new supply coming on for the next couple of years, but we're going to see continued supply growth. And I think a lot of the same questions that are affecting San Francisco are going to continue to affect San Jose in terms of longer term acceptance of remote working and hybrid models that might keep people away from some of the traditional hotspots in San Jose, where people would pay up to live near work and live in nice communities that were relatively expensive. If some of that necessity is gone, some question marks remain in terms of what type of demand snapback we will see and how we can stabilize this market. But long term, the demand drivers in San Jose are there, and it's more suburban. And the tech companies that are so dominant there are still growing, and they're very well capitalized. So I think this forecast is probably pretty accurate in terms of I think our opinion on the economy in San Jose and the type of growth that it'll continue to generate moving forward.
Yeah. I think as major tech firms, demand that you come back into the office, we'll see that swing back towards the positive. When will it happen? Most tech firms, large tech firms, were posturing for the summer. Some of them pushed that down the line to the fall a little bit. Personally, I'm feeling like as time progresses, maybe they even push that even further. Just because I don't really understand how you begin to force people back into the office when we're still rolling out this vaccine. Are you going to really jump the gun by half a year, a year, and say we want to get back right now? Or are you going to let the vaccine rollout take place, herd immunity to be achieved, and people to get really more comfortable with coming into the office until you say you got to be back in there?
So all three metros you hear, the similar degrees of the same issues just affecting the markets in somewhat different ways. San Francisco kind of feeling the brunt of it, being the most dense urban city and a little bit more difficult to get to, and it was very expensive. San Jose kind of below that, dealing with the same issues, and then the East Bay holding on a little bit better, being the cheaper and broader geography. But all three metros are following similar trends and facing similar issues in reality.
Yeah, the dense, the cramped apartment unit that's so small in San Francisco already, and you can't go outside for much right now. It's really not a desirable place to be hanging out for years on end, especially if you have a roommate. So that's going to bring us to construction activity. Now, it takes just so long, such an arduous process to even get your project started in San Francisco. But once it's actually under construction, it tends to take upwards of 2 years for that project to complete. It's a high rise, maybe even longer. So while the construction levels have been coming down over the past year, there's still pretty ample amounts of apartment supply that is still underway. Over 3,000 units in SF, over 4,000 in San Jose, and a majority of the East Bay dominated in Oakland.
Yeah, and it's if we look at the next slide, it kind of puts it in a little bit of a context in terms of where the East Bay is falling, pretty up the chain and above the national average in terms of the under construction units as a percentage of the total inventory. San Jose is right at the national average, and San Jose is a bit below. But given the more acute demand challenges that these markets faced, the higher up the list, the kind of more problematic that the new supply becomes in terms of stressing the fundamentals in the market. But we do see 2020 as being kind of the peak here in terms of the regional supply growth, and then that's going to taper off over the next couple of years. So we'll maintain the elevated, but not necessarily at the levels we saw in 2020 or a few years ago in 2016, as we taper that off. And we have seen construction start slow a bit as well. So it's kind of what we're looking at in terms of the forecast.
Yeah, so projects are completing, very, very few are starting, so that the levels of active under construction inventory are down, of course. Once what's underway finally gets completed over this year and next year, maybe we'll see even a sharper decline in 2023, but that's kind of some good news from a market perspective. If people just stop initiating construction completely, we get over the overhang of what's underway right now, and then we return to really kind of negligible inventory growth levels, I think, a couple of years down the line here. Construction really isn't feasible at the prevailing asking rents in the market, which you can see by our daily rent series here have really been crushed. I think it was back down to 2013 levels. But you can see CoStar researchers from our feeds from apartments.com. It's the most prevalent site for apartment landlord listings. This is based on over 30,000 rent observations per day. You can see that downturn really materialized at the beginning of March when we were in a seasonal up pattern, and it steadily flowed through the end of the year and most recently beginning to stabilize. So there's some nice news there, that landlords have begun to actually stabilize their rents within the San Francisco metro area. December, January, February were actually up very slightly. I mean, it's not even 0.1%, but they've essentially stabilized. A couple of areas like Soma and the Marina have actually begun to tick back up in January and February. So, some glimmers of hope there. I think a lot of landlords have decided this is about as far as low as I want to get. We're down dramatically from pre-COVID levels. And I think that downfall in demand is beginning to at least abate, if not turn, a little bit positive. We're hearing an uptick in leasing activity as of late, so from some of the landlords out there. So I think that the pace of demand losses have actually subsided, and it'll be interesting to see if we get some positivity into the market in this year or not. But concessions are also up rather dramatically on top of our prevailing asking rents. More than half of the properties in the San Francisco market are offering at least some type of concession. The new properties are offering over 2 months free rent right now. So these heavy concessions in the downturn in rents have enticed some people to move back to the market, either from Sacramento or from some other areas. We are typically an area that gains STEM graduates. So I think, some of these guys are still going to be attracted to the major tech firms and the tech startups over the long haul. And some of them are being attracted back into the market right now, seeing that affordability is actually, at one of the best levels it's been for years. If you take, I kind of track it, what I call a move-in affordability, and then we're just taking our prevailing asking rent in the market divided by the median income. It got really out of balance in the expansion period, as high as 41% in terms of that ratio, and now it's down to 27%. So, a most opportune time to come into the market right now and to get a sweet deal, especially on Soma and a new high-rise. You're never going to find it probably cheaper than what you're finding now. Still may look expensive, but certainly lower than it has been in the past.
Pretty similar in San Jose in terms of trends through 2020, and then maybe focusing more recently on this kind of stabilization that was happening at the end of 2020 with maybe some slight ticks upwards. Again, I think mirroring what Jesse said, kind of indicating that landlords might be reaching their floor in terms of where they're going to move asking rents down to. San Jose's back to 2015-ish levels here, which was a long time ago, and I think probably moved down far enough. I think the other maybe overarching thing too is, we've talked a lot about the reasons why people might have left, but I think at the end of the day, this is still a very attractive region for people to live and work in, and at some point, things will get cheap enough, like Jesse mentioned, and things will balance back out. And a lot of those same demand drivers that never went away and still exist in the region are going to, start generating a recovery here in terms of demand.
Yeah, if you moved out for affordability reasons, then this downturn in rents kind of blows that back out, right? So it's not as bad as it once was.
Similar concessions trends in San Jose, up north of 60% actually in properties that we're getting, that we're talking with, saying they're offering some form of concessions. That's a big pivot from where we're pre-COVID, and then the new projects are offering up to 6 to 8 weeks of free rent to try and entice renters into those projects and boost lease up rates a bit. And then the East Bay, similar to the overall fundamentals, held up better, kind of went through a little bit of a roller coaster ride, tried to stabilize in the middle of the year and then track back down. That velocity in terms of the decline slowed considerably at the end of the year and really started to stabilize, similar to the other two markets. But you can see the declines in rents weren't nearly as severe as they were in San Francisco and San Jose, since demand held up a bit better. But concessions were up here, just tracking consistently above 40%, well above pre-COVID levels.
So let's compare, our Bay Area markets with others across the country. You can see a real divergence really in San Francisco and San Jose, which leads me to believe maybe it isn't so much about density, but really about the work from home movement, leading to that lasting outflow in these two markets specifically. Some of these markets began to rebound in the summertime. Ours just continued to dive rather steadily. Although San Francisco kind of reached its peak downturn in August, I mentioned it subsided, and this graph only goes through October. So you can extrapolate this forward in both San Jose and San Francisco, stabilizing and even beginning to slight uptick in this year. But you can see in comparison, the East Bay was hanging in there. New York was even faring better than our markets, believe it or not. And some of the markets where our residents are moving to have actually seen an increase in rents in the pandemic period. Phoenix, Atlanta is a big one as an emerging kind of tech hub and city. Philadelphia, these are also markets where CoStar believes people are moving from expensive markets to less expensive markets that are nearby. So we believe renters are moving from expensive DC or New York to Philly. Maybe they're moving from expensive LA into Orange County. Maybe they're moving from expensive Seattle to Portland, or from Portland from the Bay Area. So that's kind of the reasoning behind why you get some of the uptick in rents. Dallas certainly makes sense with people moving over there. But pretty interesting to see some of these markets gaining in the pandemic period, while ours have suffered so severely. And then bringing it closer to home in our North Bay And I mentioned people moving to Sacramento. You can see the rent gains here. Modesto stock in Sacramento in excess of 3% gains since in the pandemic period. Vallejo Napa also rather steady hanging in there. So kind of a difference of where you're looking at in the Bay Area.
Hey, Jesse and Marco, we're coming up on our 1 hour. I think this portion of the presentation is actually really interesting. I wanted just to invite everybody just to continue to stay on with us. If you have to go, don't worry about it. We are recording this one, but I'd love for Jesse and Marco to continue with multifamily and also kind of just finish up the presentation, and then we can open up for Q&A. How long do you think we want to run before Q&A at this point? Do we have maybe 10
We're
minutes?
close to the end, yeah. So much good data to show you guys. We just
I know, just soaking it all.
didn't fit it into 1 hour.
I know. I'm gonna go ahead and let you guys continue here, but in case anybody has to leave, don't worry about it. We will have this recorded. So thank you.
So here we're looking at the differences within market and among rent losses. Most acute in south of market in the Mission Bay neighborhood. These are markets where you had a high prevalence of millennial tech renters, and you also have the biggest supply pressures from new supply coming into the market. So competition is up, rents are down most severely there. Some of these other areas are hanging in there, are a little bit more suburban friendly, more outdoor areas in the Marina Pacific Heights. Downtown SF actually includes kind of North Beach, Russian Hill area. So it is a little bit more suburban than kind of the labeling points out. But certainly there are differences, vast differences within the market. And one bedrooms and studios are down more severely than 3 bedrooms and 2 bedrooms. But you are seeing kind of this dense city center buildings, new supply, and the strongest downfall in demand. So yielding the strongest downfall in rents as well.
And this is, this type of view is really one of the best in terms of illustrating the point I made earlier about the East Bay having some divergent performance from your more suburban areas and your more urban areas. So the East Bay saw your Richmond Martinez's and your Pittsburgh Antiochs, those outlying and cheaper areas actually up year over year. Some of the cheaper markets and more suburban markets stabilizing pretty well. And then your Emeryville and your downtown Oakland really showcasing some of the worst declines. And then in terms of San Jose, much broader, but again, the more expensive, tech heavy, and then supply pressured submarkets all fared the worst, and your more outlying, cheaper submarkets fared or held up significantly better in San Jose. So interesting metrics in terms of rent kind of correlating to the demand trends and the population flow that we were talking about earlier.
So we think the downfall in rents continues a little bit through this year before we begin a more steady upward trajectory in the recovery period, according to our forecast model. Volume hanging in there as well, although deal flow is down quite a bit more dramatically than what you see in volume here. It was just kind of higher end properties in each tranche, the high quality buildings that were traded. But the downfall in sales activity is pretty high. Value add plays are probably falling off a bit, as there's kind of lease up risk in that market right now. You see the downfall in pricing here. Cap rates up a little bit, maybe a little bit more substantially than the office market, but only to the tune of about 30 basis points or so. Not much, but pretty significant downfall in pricing because of that rent potential. We kind of are extrapolating cap rates with rents and yielding this average market asset pricing. This is a depiction of what we think all assets are valued at within the entire market. So, a downfall of average of 12% for the overall market average on rents, that's going to yield a pretty significant downfall in pricing. So that wraps it up for the apartment market. Demand is still falling, but not falling at the pace that we saw at least immediately following the coronavirus outbreak and through the summer, beginning to abate a bit, but it's still falling. There's still supply growth coming online. Vacancy is still spiking. Rents dropped at the fastest rate across the nation. Most recently, they've begun to stabilize. And the investment market has certainly slowed with pricing on the downswing in conjunction with that rent potential. We've got historic job losses and a moderate recovery at this point, leading to some weak fundamentals in the forecast, could be overhang for some years to come. And kind of those same factors that we saw in the office market, the health concerns, the affordability, migration, work from home trends are key issues facing the Bay Area commercial real estate markets moving forward. That's the wrap.
Awesome. Thank you so much. That was such great information and what wonderful insight, because, it's so hard to keep track of everything in just the Bay Area alone, right? And, we're all kind of professionals in the real estate space, and it's so important to keep updated and to keep current on the trends currently. So thank you for that. Let's go ahead and do some Q&A. I know I have some questions myself, so go ahead and, Ben has a question for us, which is, can we do like a quick overview on retail? I know that was one of the sectors that, we weren't able to go over today.
Yeah, the quick overview is, well, vacancy in San Francisco has been rising since 2016, rising at an even stronger rate over the past year as a lot of malls have been vacated. Some of that space is transitioning to office space use. We see the rents are down a little bit now. Rent growth has dissipated, but the downfall in retail maybe isn't as strong as we once expected it. I think there's still a lot to be played out there as far as retailers closing shop and returning that space back directly to the landlords, and the landlords then listing it as vacant. But vacancy is certainly up. I think it's in the high teens for mall space. But it's a bifurcated market, right? Like a single triple net asset gas station or a Burger King is doing quite well. Grocery stores are fine. Pharmacies are great, but street level retail is certainly suffering. One positive note, the leasing activity did begin to rebound throughout last year after the pandemic hit, which was a national trend as well. So some retailers are still having confidence that they can make things happen in San Francisco, but I think it's a select few, and it depends on which type of retailer you are.
Thank you. Awesome. When we were going over the office spaces and talking about lag indicators, I'm not sure if this is a question that you guys might have a better insight to, but how have landlords or owners pivoted to fill the gap, right? Besides having the sublease model, or if all they're doing is subleasing, what kind of tenants are coming in that sublease arena?
We saw one of the biggest leases last year was from a biotechnology company, Veer, taking Dropbox space. So the biotech tenants have really been, holding up the market in some ways, but overall, the leasing activity really hasn't rebounded, and not many people are taking those sublease spaces so far, even though they're at a steep discount, because you don't know when you can use that space. And so I think landlords have largely been holding off on lowering rents. They think, shots in the arm and everyone gets back to the office immediately. But we'll see if that plays out or not. I think if anyone was willing to make a long-term commitment on a direct space, they'd likely get a huge concession from a landlord right now if they're willing to make that commitment. Probably TI packages or some period of free rent, because there's just not a lot of activity.
Does CoStar actually track amounts of free rent given at all, or types of tenant improvement credits typically, or?
We do track. We've got our asking rates that are listed on our platform, and we try to collect effective rents as well. Some of the TI nuances we don't get so great, but we hear from players in the market. So it's kind of what I'm reporting back to you is what I'm hearing from other brokers in the market.
Gotcha. Yeah. Okay. We do have a question from one of our attendees. Do you see landlords trying to be innovative and achieving some successes via modifying existing spaces into mixed use scenarios? And then modification, of course, would require certain approval via city planning.
Yeah, I think we're beginning to see some of that trickle in. Certainly, it's like Westfield Mall has some space that are they're converting It's actually a huge building within the Westfield Mall right on Market Street that just talking to my researchers now, they're reconfiguring the entire space towards like a mixed use, but office heavy component. So yeah, you see that transition within the retail sector. You see department stores being broken up and transitioning to kind of smaller experimental retailers. There's been, I think, more talk about converting say office space to apartments than what you might imagine is actually going to happen. Those are going to require huge capital injections. And I'm just not sure if it's really feasible to do that. But it's been talked about. It's been talked about converting some hotels into apartments or other use. And then the new developments that come up seem to be all mixed use in some array, right? Like that seems to be in vogue where if you're developing an office, you got to put in some ground floor retail or some mixed use to make it a more lively place that people want to be and are attracted to get into that area.
Right. Got it.
Reconfiguring space, I think that's been talked about as far as expanding space per employee amid the pandemic. I think it was talked about a lot, but we're not really seeing landlords willing to make that capital, commitments and say, we're building out the space and we're preparing for you. There's just not the leasing demand that would lead them to make that leap of faith in terms of capital funds yet.
Gotcha. Where would you guys see where in the next, 12 months, what the opportunity is? I know we had, drops kind of in all directions at this point, but where are the opportunities that you can see in terms of investors being able to come in, maybe in the retail and hospitality space, but again, because of the uncertainty. So where do you see kind of the opportunities being in the first, 6 months from now, and then maybe 24 months out?
Yeah, right. That's the positive side of everything is there are going to be opportunities to get in at a lower price point. And historically, investors have made tons of wealth, whatever, substantial capital gains on their investments throughout the history of San Francisco. So, buying on the downswing seems like a good pitch to a lot of investors. Depends on what property type you're talking about. So we've seen kind of a slight downfall in pricing among the office stock that has lease up risk, but it's not like there's distressed assets that have hit the market at a distressed for sale pricing. And even in the last downturn, we saw a couple of office properties trade, but it was kind of limited to like a handful. We're waiting to see if maybe some of those opportunities materialize over the next year or so. But we'd have to see, more pain in the market, just that leasing activity remain muted for some time. And I think the current owners, would have to see more pain in their portfolios. But for the most part, office tenants are still paying their rents. So, the landlords aren't suffering to the tune that they'd have to unload at a substantially lower price point. Pricing in apartments, they are down because the rent potential is way off. And if you're a believer in the long-term story here, which I think both Marco and I are, we were raised here, we know there's great intrinsics about living in the area beyond all the business activity that happens here. So I think for the long-term investor, particularly a 10-year investor on the multifamily front, even now would be probably a good time to get in because you could probably get in at a price point that is lower than what was out there in the market before. Retail going to be site specific depending. And industrial, some sectors are definitely holding up like biotech use or large distribution areas. So those are still kind of solid asset plays that you're not going to get a huge return on, but you can be pretty confident that it will be stable and be there for the short term and long term.
Yeah.
But yeah, it's, retail, you might want to wait on certain assets. I think there's going to be more pain to come. And overall, I think there's going to be more pain to come over this year. But whether that yields opportunities or not remains to be seen.
Thank you for that. We have another question from the audience. From capital and financing perspectives, which commercial asset classes do you see lenders shying away from moving forward, say, in the next year or two?
I think we saw them really fall back pretty quickly from a lot of property types, really anything that wasn't industrial, lenders balked at. and they're still kind of on the sidelines waiting to see. So, I think it's already reached its low point, coming back very steadily over time now from a lender perspective. And but investors out there are the ones that are taking the risk as well. So they're kind of on the fence of whether they should jump in now, maybe wait to see how this plays out.
Well, speaking of industrial, I would guess since industrial has been hot in the last 5-10 years even, has it suffered at all? I feel like that might be the only class in the Bay Area that might have been doing really well consistently throughout the pandemic.
It has overall, we had, such strong rent growth in excess of 8% or even 10% on a year-over-year basis, depending on where you're at. Now those rents have virtually stabilized. You're not seeing the great rent growth within the industrial sector. Those fundamentals, they've been deteriorating, but not really substantially. And then it depends like which type of industrial you're talking about. Some of the older kind of warehouse spaces that don't tie into e-commerce distribution, that's where you see the pain in the industrial market and the rising vacancy rates. And overall, it's just getting harder and harder to do business here in the Bay Area. So that's led to some demand outflow in the industrial sector as well. You can't get around just the overall slowdown in economic activity, and the downfall in trade is also leading into it. So rents, rent growth has dissipated. There's still investor interest in the area, but it has fallen off like we've seen in the other property types as well.
Oh, even in the warehouse spaces, the rents.
I believe so.
I'm going to give.
Yeah, it was.
Sorry, go ahead, Marco.
Oh no, I was just gonna say it was a relatively better performance, but it was still more of a stabilization in the industrial market or kind of a holding. We didn't continue to grow, but it wasn't as steep of a decline as the other asset classes that we saw in 2020.
Got it. Okay, I'm going to give the audience another few minutes to submit any last minute questions. But as we wait for those questions to come in, I do have one that I've been very just wanting to know is, with all that is happening with office and retail, something's got to give. So I'm sure of some of the developers or entitlement professionals out there or investors who do entitlements, they're maybe thinking about not really rezoning, but maybe being able to get those approvals for entitlements for potentially multi-family or mixed use development on what's maybe a 1 or 2 story retail office space currently here in the Bay Area. So in terms of development and re-entitlements, what have you guys seen in the last year? And then which cities have been more active in those construction or pre-constructive projects?
I think we've seen the entitlements continue full bore, because of the construction timeline. It's just so hard to make it and get those approvals. If you've been working upwards of a decade to achieve it, you're not going to turn off the spigot in 1 year. And you're cognizant of, you could have this approval and hang on to it for a year and maybe initiate construction at some point in the future, but just wait for that demand to materialize before you actually start construction. But you'd like to have those approvals in the books, I think, is kind of the standpoint from a lot of developers' perspective.
Right. Okay. We do have another question, and I think this will be our last question for the day. It's, do you see colo business such as, right, businesses such as WeWork dissipate moving forward? So the co-lease, the master tenant situations such as WeWork. I think there's industry to do that too, right?
Yeah, we see it as a major risk for our market. Our market's very saturated with co-working space more than any other market across the country. I think we saw Notel even go bankrupt and be purchased by Newmark. So I think that is the trend that could continue potentially if WeWork isn't going to make it. Maybe all those spaces don't go away, but they go back to the landlord, and the landlord's going to operate it, or they turn to a brokerage firm like Newmark, or I think wasn't CBRE also getting into the flex space providing game. So, I think it's I like the analogy to Napster as far as WeWork goes. Like, it's a groundbreaking, industry shifting transformation that happened, but will the company that actually kind of created the transformation be able to hang on and survive and reap the benefits of it in the long term? not sure about that. A lot of people say, people are going to need space on a temporary basis since they won't have the space right now, but that density is really going to be a pervading issue for the next year or so. Why are you going to want to go into such a dense kind of environment, or a place that is seen as risky because people could fill it up very quickly, and you don't know who you're working with. How are they going to regulate who comes in, who comes out? So yeah, a lot of risk there. And we know the WeWork has been giving back some spaces across the country already. I believe a couple in San Francisco. Still not profitable, so we'll see what happens.
Thank you for the answer. There's one more, actually, it might be more of a political question, but if you might be able to answer it. Are city council members working with Sacramento to make California a bit friendlier for businesses to stay rather than moving away? It's a tough one.
Yeah, well, I think San Francisco, Board of Soups is certainly not. San Francisco just enacted 3 new taxes in November. And in general, it seems like the government is trying to increase taxes to get through this pandemic period, whether they're going to know they're seeing less income coming to their books. So that's been their solution. It's kind of biting the hand that feeds them because everyone's been moving out of the area because the taxes are too high. I think eventually kind of the public word is going to eventually make its way to these legislators. We get some interesting emails from some of our clients who pepper them with emails on a regular basis, telling them what damaging effects they're having on the real estate markets, and just kind of stay out of it, let the markets play out as the way they should in free market capital system. But I don't think, Sacramento has really come to understand that yet in terms of making it a more friendly business environment or a easy environment for particularly private landlords to operate in.
Yeah, that's really tough. I think a lot of that's kind of everybody's question right now is, what's going to happen to California, even though we have tech here, a lot of our tech giants have been moving out. And so we'll continue to monitor, and thank you, for sharing all those great insights today. And I'll go ahead and close up today's webinar. It will be posted on YouTube, and I wanted to thank Jesse and Marco again for your time. Take care, everyone. Have a great rest of your day.